Okay, so this is the last video in our series on the Uniform Systems of Accounts for the restaurant industry, and this is going to be on the balance sheet. So the prior three videos were on the income statement / profit and loss statement, how to read the 8th edition, how to read the 7th edition, how to pull comparables, and then how to compare comparables, including the Deloitte & Touche National Restaurant Association Industry Operations Report, how to use that report in order to kind of evaluate and compare common-sized income statements. Now, the balance sheet, right, one of our major financial statements, is sadly almost an afterthought when it comes to financial analyses for the restaurant industry. And rightly or wrongly so, it is an afterthought because it's very difficult to compare balance sheets from one operation to the next, just because restaurants in and of themselves are so different. The way a restaurant gets funded and is capitalized. So when we say the capital structure, we're talking about how the firm came up with the capital, the money, in order to initially fund its operation. The capital structure is so different across restaurants because restaurants generally aren't able to borrow from banks. They generally have to find investors. And where and how they end up with the money to start their operations is very different, and it's just there are no generalizations that can be made from one operation to the next, and so there isn't really anything standard that you can compare from one company to the next. So there are no rules of thumb in that sense. So that being said, restaurant balance sheets do share a few common traits. Okay, they do share a few common traits. Okay, so I'm actually going to do you guys a solid here, and we're going to walk through the Vista Room's balance sheet. So I'm going to go to the case study materials that have been posted for the Vista Room, and the income statement and the balance sheet have been posted for the Vista Room, and I'm just going to download a balance sheet and open that up. And we're going to walk through the balance sheet for the Vista Room in terms of each of the points that we're going to talk about here. So I'm going to make this a little bit smaller so I can fit both of these things on the screen at the same time. So that's that, and here is the balance sheet. Got a little bit bigger. Okay, so when you open up the balance sheet, this is what you have. Okay, and the first common trait amongst restaurant or food and beverage balance sheets is that you're generally going to find restaurants run working capital negative. So if you remember the definition of working capital, it's current liabilities minus current assets. So what's kind of weird about our accounting system with the Vista Room is it has a total current asset line, but it doesn't include cash on hand or restricted cash. So I'm going to clean this up for you guys, which is to say that I'm going to delete these two lines. Total for bank, I'm just going to delete that. And all of our assets, right, for the Vista Room essentially are current assets. So just to double check that the math is correct, right? All of our assets are essentially current assets. If you want to see that, I'm going to insert in another line. Total current assets, right? And that's equals sum, essentially the cash and the accounts receivables, right? And there are no other assets, and then so total current assets are total assets. And on the liability side, we have total current liabilities. I'm going to add some lines in here. Sorry, our accounting program doesn't give us lines automatically. I wish it kind of did. Top and bottom line here. Okay. And I'm sorry, if you guys know me, you know I absolutely hate grid lines, so I'm going to get rid of grid lines. Okay, so our total current liabilities is this amount. Okay, And a healthy operation generally is working capital negative, and generally the reason, well, not healthy operation, but most operations are working capital negative just because current liabilities tend to accrue faster than current assets, because, right, the accounts payable end are generally all of your vendors, right? So all of that food that you're buying, all the alcohol, food, whatever supplies you're buying, they come in daily, if not weekly, like weekly, if not daily. So they come in very, very quickly, but the payment terms are usually for a month, right? So you're holding on to like a month's worth of of invoices, and you haven't paid them off yet. Your payroll, right? People are generally paid every 2 weeks or so, so you're holding on to a lot of these payables all at once, right? So the idea is you're racking up more payables than you are racking up receivables. What's weird about the Vista Room, though, is that we have a lot of assets for some reason. So because just we're holding on to a lot of cash. So our working capital for the Vista Room, so working capital equals current assets minus current liabilities. Okay, I'm going to open that up a little bit more. Current assets minus current liabilities, and so that's equal to current assets minus current liabilities. And you'll notice that we are very, very working capital positive, and that's because we're holding on to all this cash and we have a lot of accounts receivables. The university actually makes us hold on to all this cash, so that's why we're so working capital positive, because we actually have to put a deposit down for all of our future purposes. So this is actually a risk management reason. But in general, you will find that a restaurant will not hold on to this much cash relative to how much money it owes. In most places, you'll find that there are far more current liabilities than there are current assets. So in this sense, the Vista Room is very, very different on its balance sheet. Another general trait that you'll find on restaurant or food and beverage balance sheets is that there generally aren't any accounts receivables unless there's some sort of side business or instance where the operation would be billing another party for some goods or services, right? So other goods and services being if there's catering, the biggest reason would be if there's catering and banquets or events operations. There will generally be a separate line item that's like catering and banquet sales, in which case whenever you bill like the catering client or the events client, if you haven't received payment on that bill, it goes into accounts receivables, right? So the Vista Room has a lot of house accounts where people can charge to an account, and then we send an invoice, and if the invoice isn't paid, it's an accounts receivable, and we have to wait until we collect on it. Hotel food and beverage operations will generally have large accounts receivables because they have banquets and events, room rentals, that will generally be logged as accounts receivable because an invoice is sent, and they usually aren't instantly paid. Guests usually have like 30 days to pay that invoice, just like kind of your credit card bill. You have 30 days to pay your credit card bill. Whenever you send out an invoice, you generally give the customer some time to pay that invoice also. So another thing that's odd about the Vista Room is that we have an accounts receivable balance, and that's because we have ancillary revenue in that we have catering and banquets and events revenue too. Okay, a place like Cheesecake Factory will also have accounts receivables because they license their name out for use on other products, right? So they lend or they sell people the right to use the Cheesecake Factory name, but what they also do is they have wholesale selling accounts. So they have a bakery operation where they make cheesecakes and pastries for Barnes & Noble, for example. If you go to the cafes within Barnes & Nobles, you'll notice that they're Cheesecake Factory products. Cheesecake Factory will sell their bakery items to Barnes & Noble, send them an invoice, and until the invoice is paid, that balance shows up in accounts receivables. Okay, So another thing that food and beverage operations generally have in common is that a healthy food and beverage operation should have enough cash on hand to cover at least 3 months of its current liabilities. So if you go here, right, current liabilities and enough cash on hand. Okay, so if I do 3 times current liabilities equals 3 times current liabilities, this is how much cash I need to have on hand in order to be like super healthy, right? And the idea is I need to have enough cash on hand if just like, you know, E. coli breakout happens and I can't sell a single product, will I still be able to keep the doors open, right? And you should be able to at least keep the doors open for 3 months to kind of get yourself back on your feet is kind of the thinking. If all hell breaks loose, can I still keep the doors open for at least 3 months? So 3 months worth of current liabilities is this, and I compare that to how much cash I have on hand. So that's, I'm going to see, this amount of liabilities, 3 months worth of liabilities, and it's covered by this, all of my cash. And I have more than enough cash to cover that $16,838, right? I have $52,822 more than 3 months worth of working capital. Another way that you can calculate and determine whether it's, you know, 3 months worth or not is if 3 months worth of current liabilities divided by your cash amount is less than 1 or not. And we are very, 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 very much less than 1. Okay, so the numerator of 3 months worth of liabilities is a lot smaller than the denominator, which is the amount of cash that we have to cover it. Okay. Okay. So, you know, we've talked about how generally restaurants don't have a lot of receivables. And we've also talked about how generally restaurants are working capital negative. In both instances, the visitor room kind of breaks the mold on that sense. We've also talked about how a healthy food and beverage operation will have more than 3 months worth of total current liabilities in cash, you know, to kind of just maintain operations. And the other thing to kind of take note of is that the absolute size and portion of assets that are held in property, plant, and equipment for a food and beverage operation will just vary greatly. And you'll notice that on the Vista Room balance sheet, we don't list property, plant, and equipment. There are no long-term assets that are listed, and this is for kind of 2 reasons. The university itself owns the assets, the property, plants, and equipment inside the Vista Room. So the Vista Room technically doesn't own it. It's just the shell of an operation. And so it's not held on our books. We probably could try to find an accounting of the property, plant, and equipment, but we haven't gotten there yet. The accounting hasn't gotten there yet. So outside of the Vista Room, right, the reason why the size of PP&E is going to vary from one operation to the next is depending on whether the operation owns the real estate or not, right, will affect the size of the property, plant, and equipment. If we own the real estate, PP&E will be high, right, because the value of the building will be in PP&E. If we leased the building, right, it depends on the type of lease that we have. If it's an operating lease, the value of the building will not be in PP&E. If it's a capital lease, the value of the building will be in PP&E, and that's a discussion for, you know, HTM 458. Hopefully you remember that from HTM 458. So again, how big PP&E is really going to depend upon whether you own the real estate or not, and it'll depend on the type of lease that you have if you're leasing the property also. Okay, the amount of PP&E is also going to depend on whether you lease or own the equipment and just how much equipment you end up owning. So a lot of operations decide to lease certain types of equipment, delivery trucks, their point of sale system, their computer systems, their ice machines, their refrigeration, their storage. It just depends on what you've decided to lease or not lease. If you own it, if If you bought all that equipment, right, it's going to show up in PP&E. If you didn't buy the equipment and you decided to lease it, it's not going to show up in PP&E. The age and the useful life of the PP&E is also really going to matter. So there are a lot of really old school pieces of restaurant equipment that were designed to like last through a nuclear holocaust. But for accounting purposes, a depreciation schedule has to be assigned to it, right? So buildings are generally depreciated over a 40-year lifespan. Equipment is usually depreciated over a 7-year. Furniture fixtures are that type of, you know, kind of wares are depreciated over a 7-year life. Though, you know, there are plenty of restaurants that are in buildings that are over 40 years old, right? They own the building and it's been there for over 40 years and it's just fine. If the value of the property has been completely depreciated away because, you know, the property is just very old, PP&E may be very, very low, right? We may be using equipment, for example, like our stand mixer inside the visitor room kitchen, right? It is way past its useful life. Its book value has already completely depreciated away, but we're still able to use it, and so our PP&E would be understated in that sense too. So again, the size and proportion of assets that are held in PP&E will vary greatly, mostly depending upon these three aspects. Okay. And kind of the last thing to think about, ooh, and I don't know why my screen is doing that. But maybe we'll go back. Okay. Another thing to notice on balance sheets is the inventory. The value and the proportion of assets in inventory is going to vary greatly depending on the type of operation that you have. Different types of operations will have very, very different inventory requirements and inventory levels. And most notably, for example, high-end restaurants with really developed wine programs are likely to have very large wine cellars and very expensive wine cellars. So for example, the French Laundry was recently broken into and over $250,000 worth of wine was stolen. Restaurant Daniel, out in New York City, they are a 3 Michelin star restaurant. Their wine inventory is upwards of $10 million alone. So, of course, the proportion of assets on their balance sheet that are allocated to inventory is going to be huge just because they're holding so much wine. Similarly, concepts with bars, right, are going to have a stock of liquor also in order to have like a full bar, right? So then you can also imagine the type of bar that you are. If you're, say, like a high-end scotch or a whiskey bar, you're going to have some really expensive high-end scotches and whiskeys, which will also increase the value of your liquor inventory. So the proportion of inventory, of assets held in inventory will also go up. You'll also find that a lot of steakhouses, very, very high-end steakhouses that do butchery on premise, they dry age their steaks. And so the steaks need to be butchered and then held on premise for months at a time so that they can dry age on premise. So steakhouses, high-end steakhouses oftentimes will have high inventory levels also because they're holding on to so much steak. There are a lot of artisan concepts that cure their own meats and cheeses, and these places, just like the steakhouses, are holding on to and sitting on a lot of food inventory specifically to age that food inventory. So, you know, meats have to cure over months, sometimes even years. Cheeses have to cure over months, if not years also. And so these artisan type of concepts may have a disproportionately large portion of their assets held in inventory. Okay, so keep in mind all these aspects, right? All these considerations when you're looking at a company's balance sheet. And because of these factors, right, you really can't compare one balance sheet to a next because there are just way too many moving parts. But the way that you would analyze a balance sheet is just to go through line by line and discuss why that line item is particularly high or low given the unique operating situation of the concept that you're talking about. So remember, do not compare from one operation to the next. The balance sheet, it is worthwhile sometimes to compare the balance sheet of the same company from one year to the next to kind of see where the changes have occurred. And remember back on the Vista Room balance sheet that we have several odd things to take note of. One of which is we have a lot of total current assets relative to our liabilities. We have no long-term assets listed on the balance sheet because the university owns all of our long-term assets. We are relatively current liability light compared to the amount of current assets that we're holding on to. And that's primarily because the university requires us to hold on to cash in order to, from a risk management perspective, cover the future purchases that we're going to be making. We also have a large accounts receivable balance because we bill out catering and banquets and have house accounts that people can charge to, that departments on campus can charge to. And that's about it. We have a total non-current liability, which is unearned revenue. This unearned revenue are prepaids, are prepaid meal tickets for the Vista Room. So in total, our guests have prepaid for $7,820 worth of meals inside the Vista Room. So think of this as almost like gift certificates. They're actually called block tickets, but think of them as gift certificates or gift cards that people have purchased in the past but just haven't redeemed yet. So you'll notice here that we've collected $7,800 worth of cash. So and we owe this amount of to be eaten meals inside the Vista Room. So this is kind of what this line item of unearned revenue is. We can't count this as revenue yet because we have not performed the service. We have not actually served out these meals yet. We're holding on to people's money for a service that they have not yet redeemed. So this is why we have not yet earned the revenue that we have collected. So that's why it's sitting in as a liability, because we're liable for this value. That's why this amount exists. You'll find that a lot of restaurants these days will have a large unearned revenue or a gift card balance. And then you're probably wondering, so why do you have a gift card liability then? So these are actually gift cards that we've issued separately, and we expect them to be redeemed within the next year. That's why they're under current liabilities, whereas these are non-current because they've just been sitting around for a very, 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 very long time. And as another aside, according to California state law, we can't expire these. They don't expire, so we just have to kind of hold them there. Okie dokie, and that's just about it for the Vista Room's balance sheet and for our discussion on how to read Uniform System of Accounts balance sheets. Don't compare balance sheets across companies. Okay.